Picture this scenario. You just landed your first real job, and during orientation, HR starts talking about something called a 401k. Your eyes glaze over as they throw around terms like employer matching and tax deferral. Sound familiar? Well, you're about to become the most informed person in that room because today we're breaking down everything you need to know about 401ks in plain English. Let's start with the absolute basics. A 401k is essentially a special savings account for retirement that your employer sets up for you. Think of it as a piggy bank that comes with superpowers. Here's how it works in the simplest terms possible. Imagine you're earning $60,000 per year. Normally, you'd pay taxes on that entire amount. But with a 401k, you can tell your employer to take a portion of your money directly from your paycheck before taxes are calculated and put it into this special retirement account. So if you decide to contribute $6,000 for the year, you'd only pay income taxes on $54,000 instead of the full $60,000. That's an immediate, tangible tax saving right there. It lowers your tax bill today. But here's where it gets really interesting. The money in your 401k doesn't just sit there collecting dust like it would in a regular savings account. Instead, you get to invest it in a menu of options, usually things like stocks, bonds, and mutual funds. And here's the real kicker. Any growth or profits from those investments are completely tax deferred. That means your money can compound and grow for decades without you having to pay taxes on the gains each year. Uncle Sam doesn't take a cut while it's growing, allowing your retirement fund to grow much faster. Now let's talk about the feature that makes 401ks absolutely irresistible. It's called the employer match. This is literally free money, and I am not exaggerating. Many companies will match a portion of what you contribute to your 401k as an incentive to save. Let's use a common example. Say your company offers a 50% match on your contributions up to 6% of your salary. On that $60,000 salary, 6% is $3,600. If you contribute that amount over the year, your employer will throw in an additional $1,800 for free. That's a 50% return on your money instantly, guaranteed. You simply will not find that kind of return anywhere else on the planet. Some generous companies offer even better matches, like a 100% match, meaning they'll match you dollar for dollar up to a certain limit. Even less generous companies might offer a 25% match. The key point is this: if your employer offers any match at all, you should contribute at least enough to get the full match. Not doing so is the financial equivalent of finding a winning lottery ticket on the ground and just walking away. You are literally leaving free money on the table. Of course, 401ks aren't perfect, and you need to understand the downsides, or maybe let's call them the rules of the game. The biggest one is that your money is generally locked up until you reach retirement age, which is currently 59 and a half years old. If you need that money earlier for a non-qualified reason, you'll likely face a 10% penalty on top of paying regular income taxes on the withdrawal. There are some exceptions for major life events, like buying your first home or becoming disabled, but in general, you should think of this money as off-limits for decades. Another rule of the game is fees. 401k plans charge various fees for managing your account and for the investments themselves. These can range from as low as 0.5% per year to as high as 2 or 3% annually. That might not sound like much, but over 30 or 40 years, high fees can seriously eat into your retirement savings, potentially costing you tens or even hundreds of thousands of dollars in lost growth. It's crucial to ask HR about the fee structure and always try to choose the low-cost investment options, like index funds when they're available. The third major limitation is that you have a curated menu of investment choices. Unlike opening your own brokerage account where you can buy almost any stock or fund you want, 401ks typically offer a smaller list of maybe 10 to 30 options chosen by your employer. For most people, this is actually a good thing because the options usually cover all the basics you need for a well-diversified portfolio. But if you're a sophisticated investor who wants to buy specific individual stocks, you might feel a bit restricted. Now let's cover some crucial details. First, contribution limits. These numbers change, but for 2026, you can contribute up to $23,000 per year to your 401k. And if you're 50 or older, you get to make catch-up contributions, allowing you to put in an additional $7,500. You absolutely do not have to contribute the maximum. You can contribute as little as you want. You can start with just 1% of your paycheck if that's all you can afford. You can also change your contribution amount throughout the year. Get a raise, log into your account, and bump up your percentage. So, what happens when you eventually retire? When you start withdrawing money from your traditional 401k, you'll pay regular income taxes on those withdrawals. Remember, you got a tax break when you put the money in, so the government gets their share when you take it out. The hope and the common scenario is that you'll be in a lower tax bracket in retirement than you are during your peak working years, so you'll end up paying less in taxes overall. Some employers also offer a Roth 401k option. This works the opposite way. With a Roth, you contribute money after taxes have been taken out of your paycheck. There's no immediate tax deduction, but the reward comes later. All of your withdrawals in retirement, including all the investment earnings, are 100% tax-free. This can be a fantastic option if you're young and in a low tax bracket now, because you expect to be in a much higher bracket in the future. You can even split your contributions between a traditional and a Roth 401k if your plan allows. And what happens when you leave your job? The money you contributed is always yours 100% from day one. However, that free money from your employer, the match, often comes with a vesting schedule. This means you might have to work for the company for a certain number of years before you get to keep all of their contributions. A common schedule might be that you're fully vested after 3 years. If you leave before then, you might have to forfeit some or all of their match. When you do leave, you can leave the money in the old plan, transfer it to your new employer's 401k, or roll it into an individual retirement account, an IRA. Just avoid cashing it out if at all possible, to avoid those hefty taxes and penalties. So, what's the bottom line? If your employer offers a 401k with any kind of matching contribution, you should sign up immediately and contribute at least enough to get the full match. Start with whatever amount feels comfortable. The most important thing is simply to start. The power of starting early cannot be overstated. Thanks to the magic of compound interest, someone who starts saving at age 25 will likely end up with significantly more money at retirement than someone who starts at age 35, even if the older person contributes more money over their lifetime. Time is your single greatest asset. Don't let confusion or intimidation keep you from taking advantage of this incredible tool. A 401k is one of the most powerful wealth-building vehicles available to regular people. Combined with an employer match and decades of tax-advantaged growth, it can turn modest, consistent contributions into a retirement you can actually look forward to. The key is to start now, contribute consistently, and let time work its magic.